welcome to the Investing Show. Joining us now in the studio, we've got Chris Hiorns, manager of the Amity European Fund. Chris, welcome to the show.
Hello.
Now, I think it's always dangerous to make a sweeping generalisation, so I'll start the show with a sweeping generalisation. I think to many investors and to many people who've taken interest in the financial market and economies, Europe still gets put into a certain box, which is it's got problems. But is that true? How does Europe look overall at the moment?
Well, I think surprisingly, maybe actually Europe looks very good at the moment. For the first time since the credit crisis, really, we've got good, solid GDP growth across all the major economies in Europe. Germany obviously has been growing very nicely for quite some time, mainly based on its export performance. But now increasingly that's moving over into the domestic economy, so we're seeing a pickup in construction, in retail sales, and in business investment in Germany. So the German economy remains very strong. But I think, looking at some of the other economies which maybe haven't been performing so well, they are, starting to pick up now. So France is growing at around 1.5% to 2%. Maybe a bit of a laggard in terms of putting through economic reforms. But we do have Macron now just come into power, and he says he's very keen in terms of restructuring, so we've possibly got a positive story coming along there. The Spanish economy is doing very well. It's growing at around 3% this year, expected to continue growing at around 2.5% next year. So again, very positive, good growth. And even Italy, which is really one of the big laggards, quite damaging demographic policy or profile. It is also expanding, growing around half to 1% GDP growth a year. So overall, it is the best outlook for Europe than we've had in the last decade. And I think also, if you compare it to the US and to the UK, we've got a fairly young recovery in Europe compared to the US and compared to the UK. So whereas the brakes are beginning to be applied, however gently, in the US with rate rises, and we've also seen QE beginning to be pulled back in the UK as unemployment falls to very low levels. It's around 5% in both areas. In Europe, there's still a lot of slack. There's a lot more recovery to come, and so of those sort of major developed regions, I think Europe probably got the most positive outlook from here going forward, especially when you look at the relative valuations of, say, European equities compared to the US.
Does that make life easier for you as a fund manager if the rest of the world thinks the glass is half empty? Is it easier to look for companies in an environment where most people think, oh, that looks bad, I'm not so keen on that?
Well, I think Europe has had a good run. It's had a good 3-6 months. It's performed very strongly. We are seeing a lot of the bourses hit new highs. So in part, that story has already been reflected in the equity markets. I think some bits of it are perhaps coming quite hot at the moment, but I still think there is good value there. And it does look good value, as I say, again, compared to the US in terms of sort of book value or forward PEs. And also, of course, because it's at this early stage of the economic cycle, net profit margins are a lot lower in Europe than they are in the US. So I think there could be an expansion in margins, which will mean that the PE will fall just by margin expansion in Europe. So I think it's not as cheap as it was, and it is recognised that Europe is an attractive place to invest, but I think still compared to US, UK, the equity market looks good value, and certainly compared to the fixed interest market. I mean, you're getting a 3.6% yield more or less off the European equity market, whereas bond yields are down at 0.3%. So compared to other asset classes, I think the European equity market still looks very good value.
In terms of the UK-US comparison you just made, obviously we had the waves of populism washing up on both of our shores and also the US. There seems to be more of a connection between politics and the markets, and arguably there should be. But that aside, is Europe now home and dry in terms of having avoided populism?
I'll sort of answer your question in reverse order. And firstly, no, it's by no means home and dry in terms of the rise in populism. I think, although I think we're pretty safe with the German elections, obviously in terms of the Dutch elections and the French elections, we've not seen those populist parties come to power, although perhaps you could argue that Macron himself is a centralist populist party. But on the whole, the establishment is still in control there. We've got a lot of risk in terms of the Italian election coming up. We have Five Star possibly ahead in the polls, although it didn't do so well in the recent local elections. But also with Lega Nord, they would actually have a real chance of getting into power. So no, we're not home and dry in terms of populism. Although, as the economic recovery gets going, then maybe we'll see these forces of populism begin to decline. Though when that happens, it's difficult to tell. Obviously, it didn't work in America. You had the economic recovery, but because that didn't feed its way through to ordinary people, populism still retained its appeal. So I think, in part, dealing with inequality is going to be an issue as this recovery gets going. That if the recovery doesn't trickle down to ordinary people, then populism could become a real issue, as it potentially is in the UK as well. On the second point you raise in terms of its impact on the markets, I think what you said was absolutely right, that political uncertainty can have big impacts on the valuations of relative markets in different countries. And this really can present opportunities, because I was looking for where can I find the best value, where are the sort of cheapest companies with good prospects, good quality companies. And prior to the first round of the French elections, I was finding them in France, because the market had been sent to a discount because people were very nervous that Marine Le Pen might get into power. And that presented a good opportunity to buy some of these companies. And if you look slightly further back, in the case of Italy, where there was a sort of triple header of negative news related to Italy. We had bond yields go up in the US, which impacted long duration stocks in Italy. We had the botched referendum on the constitution, and we had potential fall of the government, and we had a sort of banking crisis going on. This led to quite a big sell-off into the Italian market, which again was an opportunity to buy in to some very good quality companies that really shouldn't be that affected by changing political situations. So it can present opportunities, and it also maybe makes you cautious going forward in some markets. So after post the German election, which I think we can be quite comfortable with, that Merkel will remain in power, people might start looking forward to the Italian election, all the uncertainty there, and we might see the Italian market begin to derate against some of the other markets in Europe. But that does create opportunities as well as problems.
And do you only look to those major European nations, or are you also hunting for companies on the periphery in some of the smaller European nations?
Well, there are some smaller countries I'm not invested in, I think have real structural problems and quite deep economic problems. So the likes of Greece and Portugal. Other smaller economies, I think, yes, there are very good opportunities there. So I'm certainly invested in some of the Nordic nations, which obviously have performed very well over the credit crisis as a whole. So I'm invested in Finland, I'm invested in Norway, but also some of the periphery countries that have suffered, do have attractions as well. So Ireland, I think, it had obviously awful performance post the credit crisis. It was very heavily exposed to what was going on in the US and in its own housing market, but it has done immense amount in terms of reform, restructuring its banking sector, and it is a very flexible economy. Naturally, it's got a low taxation economy, which is attracting investment into the US, and it looks like a very good market to invest in at the moment.
What do you look for in a company when you're looking for companies?
Primarily, we're value-based investors, so we're looking for companies which have potentially high dividend yields, good cash flows, strong balance sheets, often ones which we feel are undervalued by the wider market. So maybe a contrarian stance, which sort of almost comes naturally out of value-based investing, because you're looking for companies which are valued at a discount to the wider market, and that could be in terms of book value as well. And maybe we also feel that often there tends to be a reversion to mean in terms of operating margin. So a company which has a low operating margin, but which we believe over time that operating margin is likely to recover, so looks cheap to us in valuation grounds going forwards.
I think anecdotally, and for the reasons you mentioned earlier, it seems as though a lot of US professional institutional investors are now looking towards Europe for the very reason that you mentioned, that they see Europe as being in the sort of part of the economic recovery that they might have been in a couple of years ago. Notwithstanding what you just said about individual stocks, are there any particular sectors which are looking good at the moment? Because obviously there still seems to be a bit of a question mark over the banking sector in Europe, for example, which is, in normal circumstances, would be oiling the wheels of recovery.
I think there's a huge amount of difference between the banking sector in different European economies. It's clearly valued at a discount to that in the US. I think the US is trading at currently around 1.3 times book. In Europe, it's trading at around 0.8 times book. Within that, there's very big differences. I wouldn't want to invest in Italian banks. I mean, if you see the level of bad debt provisions in Italy, it's extremely high. The legal structure just isn't in place for banks to restructure their loan books. And I'm not convinced that necessarily all the bad news is in the provisioning yet in places like Italy and to a lesser extent in Spain. Other markets, the banking sector has been restructured, has been reformed, and on a stronger basis anyway. So, I'm invested in banks in Holland, for example, where I think that those banks have done an awful lot. They've sold off non-core businesses, concentrated very much on their own banking business. They're investing in new technology, which I feel are attractive. I mean, Ireland, which I mentioned previously, is another example. I mean, we've got Allied Irish banks coming back to the market this week, potentially via an IPO. And again, they've probably over-provisioned, so they can release those provisions back into the market, particularly as the Irish market recovers and property prices begins to pick up. So, some of those loan to values which are up above 100% will start to fall back, and they can write back some of those provisions they've taken into capital.
Are you able to tell us about any companies that you particularly like, to give an example of the best of what Europe has to offer?
One area I am interested in, which is as a value investor, sort of a growth market, is probably the media content industries. I think Europe sort of misses out that it doesn't have the FANGs, it doesn't have the Facebooks, the Apples, the Netflix, the Googles, those internet software companies that have done it, or service companies that have done very, very well. But it does have some good content companies, and I think many of those remain relatively attractively valued. So I'm talking about the professional publishers, Walters and Reed. In terms of media companies, there's Vivendi, which I think its music asset is actually very valuable. The music industry has for many years seen falling sales as people buy far less physical music. But increasingly, we're spending more and more time online. We're willing to pay for things online via advertising. Content gets paid for as well. And they are beginning to monetize those flows. So I think they might be at an inflection point where, having suffered for a long time through losses through digitalization, they may now be able to take advantage of this new economy. And we've seen it recently with a deal with Spotify. So that would be an example. And also the advertising companies. I think that as more and more sales go online rather than shop-based, it becomes more and more important for companies to get their brand across, to get people to know who they are, and it's via advertising they do that. So I think that's another industry which should benefit from these trends.
So almost these industries that have been sort of considered to be a part of the past by a lot of people, but actually the one thing that they do have to draw on is a huge depth of knowledge that they've built up through the years, and an asset base, like you say, with all the music. Is eventually, once you start to be able to monetize that, you can start to make money off it.
Exactly, and that's what we're seeing happen with Vivendi. I mean, in terms of the publishing companies, they've been doing it for the last over 5 years ago that they hit this inflection point from losing revenues from decreased print sales to making more money by selling products over the internet. I think that same trend is likely to happen to the music industry. So there are opportunities there.
Chris, that's all we've got time for. Thank you very much for joining us on the show. Richard, thank you very much for joining us.
Pleasure.
Thank you very much for watching. Join us next time on The Investing Show. Goodbye.